we will have Mr. Theophilou Yorgos as our last speaker to open the discussion to something different that has to do more on how we see taxation on a worldwide basis, global taxation for digital services to be designed. So what are getting a flavor of the main trends of OECD taxation, because what the tax system of tomorrow will be is the environment where finance people and tax advisors and accountants are to practice and perform. So it's interesting to understand how we have more and more digital economy. So the big clients are the ones that they operate through e-commerce and they provide digital services. They haven't been traditionally our clients compared to Ireland, for example, that does serve this kind of clients. But this, at the same, it means that we have some room perhaps left to gain some of this stake of the market. We can perhaps offer them some new concepts, business product, business lines for these digital companies, or think of taxing them if we don't want to go that way, the way of offering products, go for taxing digital activities on our territory to recover taxes. How it could be, we got the permanent establishment, digital permanent establishment. Christo, you want to present us something from pillars, the OECD pillars?
Yep. Many thanks, Eleni, for the wonderful introduction. I agree with you that the world will not be the same in terms of international tax. Before I share my presentation, I would like to make some comments to the previous discussion that we had, that it was very fruitful, and I will give my flavor as a tax practitioner first, and also as a provider of a UK tax qualification here in Cyprus. I will say that I agree with my previous panelist, is that for us as tax practitioners and in the private sector, it will not make any much difference because as we studied in the UK, we acknowledge the level of, I will say, education, either academic or professional qualification. So we will never say that we will not hire this person because you have a UK tax qualification or so. I don't imagine that someone will do it, but most likely the private sector will not do it. I agree that this will be left to the government if needed somewhere to be recognized or not. Another thing that I would like to mention is that in terms of taxes, and this will be my presentation as well, Cyprus was traditionally, in brackets, supported by the UK to take aggressive measures. For example, we have the ADA directive, the Anti-Tax Avoidance Directive, that surprisingly was approved by the EU Commission after the Brexit. Or another instance that our IP box was kind of protected because the UK was also in favor of us. So the Brexit will actually, Cyprus will maybe, someone could argue that we are going to lose a very good friend that has a big power within the EU in order to protect the aggressiveness of the EU in terms of providing a very, I would say, aggressive tax avoidance schemes that they're doing. So I will say that this is an impact, and we're going to see this later on. we don't see practically the people having less interest in terms of our qualification. So I don't think that there will be a big impact on that. In Cyprus, we traditionally have good relationships with the UK, and it is very well accepted, at least on the private sector side. Now, turning out to what the previous speaker said is that now it's like the teaching, because I am teaching as well international tax. It's good that we need to increase our level of and quality of our education in Cyprus. For the mere fact is that if I want to make a very good online course, now it's very easy to find it. You can do it now in Cyprus. I myself, previously, I need to fly to the UK to do my tax LLM. I need to fly to IBFT to do a very good online course. Now I can do it from the comfort of my home. So this means that in competition, we are a huge small world, I would say, because everyone is united. And from my experience as a lecturer, because as I mentioned, I lecture, I used to travel to lecture. So I need to take the airplane, go to another country, lecture, and then come back. Now I'm doing it from the comfort of my home. And my experience is, I would say, whatever I was doing in class, I'm doing it via Zoom. The only condition is that the attendees need to be engaged. If they do that, I will say they get more or less the same value. Okay, in class is always different, but I will say they get a very good comprehend of the course. So in these terms, I will say that as a country, I definitely agree we need to increase the level of our education in order to be able to compete with the online courses found abroad. So this is my view of what we said, what we mentioned until now. Let me share my screen so I will be able to do my presentation right now. I guess that you see my screen, right?
Yes, we do.
Okay, Eleni, please assist me when I change the slides. If something is wrong, let me know. So what I will be presenting today is about the OECD and the EU initiatives in terms of tax policy and the changes that we see for the last 10 years. I will say that the international tax is split in two periods. The one is the pre-BEPS that started in 1920 with the League of Nations in order to avoid double taxation. And the second era of international tax is post-BEPS. The BEPS project is an initiative of the G20 that gave a mandate to the OECD. And let me say that the OECD is working closely with the EU. They are not doing something on their own in order to avoid the base erosion and profit shifting from countries to tax havens. Today, the inclusive framework of the OECD includes 125 countries. And from here, you understand how huge is this initiative since 2013. Now, what is the scope of the BEPS project is to prevent double taxation. We used to structure activities without having any tax at all, but this is not the case right now. The next one is to avoid no or low taxation. Again, low taxation is not acceptable anymore, specifically with artificial entities. They want to achieve coherence within the international tax system. And what we need to have in mind that all these new anti-tax avoidance directives, all these new anti-avoidance provisions, they need to be in line with value creation. So all the countries around the world, if they want to have M&Es in their jurisdiction, if they want to have this business sector that we are saying in Cyprus fiduciary, they need to provide value creation to their clients in order to be eligible for tax benefits and eligible in order to be bulletproof from a tax perspective from other countries. Now, unfortunately or fortunately, this is debatable. The outcome of the BEPS project, it was in October 2015, was not satisfactory. And therefore, the OECD continued the work. And in January 2019, the OECD and the inclusive framework, they said we need to find a consensus approach in two pillars. Pillar one is about the digital economy, and I will explain what we mean. And pillar two is everything else other than digital economy. So in order to understand, because this is a reform that covers almost everything, what I would like to say is that when we are doing a reform, we consider three things. A tax system, it taxes taxable persons. These persons are individuals like us, physical persons, and then legal entities. It taxes the tax base of those taxable persons, and the tax base is simple, income less expenses, and on that tax base, you apply a predetermined rate, which in Cyprus is at 12.5. Now, this is quite simple. However, the big multinationals like Google, Apple, Netflix, they manage to get out of this equation and do not pay any taxes. And let me explain how this is done. Now, what the digital giants are doing, the digital giants are effectively avoiding in this slide the taxable person. You don't see Google and Netflix or in countries such as Cyprus, Greece, Russia, or whatever. So there is no taxable person in that country, and they don't have any taxable income. Why they don't have a taxable income? Because, for example, let me give you an example with Amazon. I used to go to my neighborhood bookstore and buy books, but now I use my iPhone. I have an application called Amazon, and with one click, I buy a book. This book is delivered to my home, and I pay Amazon. That is definitely not in Cyprus. The same happens with Netflix. With Netflix, I used to pay my local cable provider to watch television. However, now I pay Netflix. That is not in Cyprus. They don't have a taxable presence in Cyprus. And all these incomes, they flow to Netflix without being taxed in Cyprus. The same with Google and so forth and so forth. Imagine now, we don't have a server room. Everything is on cloud. We don't have cabling structure. We don't have phones. Everything is software on my iPhone. So we don't have all these services. What does this mean effectively? The EU and the OECD believes that in the next 5 to 10 years, the countries will not have a taxable base because all these electronic means, they are moving the tax base from the countries to the cloud. And if you move to the cloud, it means that the big digital giants, they have the option to move the taxable base from the countries to the country of their option. And usually the country of their option is a country that does not tax that income. So effectively, if they do nothing in the next 5 to 10 years, I've seen studies that if they do nothing in the next 5, 10 years, countries will not have much taxable base to apply a tax rate. So if we go back to this equation, they don't have a physical or a legal person to tax, and they will not have a tax base. So even if they want to apply their tax rate, they will end up getting zero. So if they don't do something right now, in the next 5 to 10 years, they will get nothing. This is their concern. And let me point something in this equation is that this study was pre-COVID. With the technological rate that was running pre-COVID, they were estimating this to happen in the next 5 to 10 years. Imagine now what it will happen after COVID. After COVID, I will say it's not 5 to 10, it's like 5. I will not go to 10. So the big issue with the digital economy is to find a way to get the tax base of those countries. This will correctly, as Eleni mentioned.
Yeah, it's important. I think it's a key factor to explain that if one actor is not taxable, it has a competitive advantage over all others that are taxable. That's what speeds the process for the states to lose revenue they now collect from other business actors that are effectively taxable.
Yes, correct. And that's why there's a big war, Eleni, and you are correct that you are saying, is that now the EU, they want to impose a digital service tax, and the US giants are moving away from this, I will say, equation, is because the majority of them are US-based digital giants that they are effectively trading in much less price than the EU digital giants, and they are more competitive because they pay less taxes, so they can be trading in a lower margin, and so they have better prices. So this is the big issue. There is a war, I mean, around the globe, and that's why from 2013, we don't have a consensus on digital taxes. Now, what Cyprus can do on this, I will give you an example. In Cyprus, we have digital giants, and it will be good for us to develop this industry in Cyprus. On my iPhone, now I use the application 3CX. This is a soft phone. The soft phone effectively replaced my IT system and my telecommunication system here in my office, because it's all everything on my iPhone. But 3CX is in Cyprus. So if we are able to attract 3CX, wargaming, and so on, this will be a good move for Cyprus. This is the future, and we cannot avoid that. The only thing that we can do is to adapt to that situation, because everything is going digital. Now, the second pillar is pillar 2, which is effectively the OECD is trying to identify the same playing field around the world. So they are trying to have a minimum global tax rate. So if there is a minimum global tax rate, there will be no need to effectively move profits from one jurisdiction to another. What I will say that is here that the OECD admits that they cannot solve the problem. So they say we cannot solve the problem. Let's agree a global minimum rate, and therefore there will be no incentive for the big giants or the big MNEs to move their profits from one jurisdiction to another. Of course, there is no consensus until today, but what Pascal says, which is the head of the OECD, Pascal said that the minimum tax rate is expected to be the 12.5 corporate tax rate of Ireland, and not Cyprus, but it's the same. So Ireland is not by luck that he said Ireland. So Ireland, maybe it will be a good country that we can follow in Cyprus for obvious reasons. Also, there is another minimum rate. It will be for treaties effectively, and this will be a subject to tax rule for 7.5%. However, the total minimum rate, it will be the 12.5. So you imagine that countries that they have low tax rates, they will be effectively affected from these minimum standards. Now, the personal scope excludes entities like investment funds, pension funds, and so on. I have highlighted here investment funds because this is, I would say, a specific sector that Cyprus needs to invest, because this sector will be excluded from Pillar 2. I am saying that Pillar 2, let me point here that Pillar 1 and Pillar 2 are not agreed yet. What I am presenting to you here, it's the draft blueprints that they are going for approval. So something might change, but usually they don't make big changes when the blueprint comes out, but still there needs political consensus. Now, the shipping industry that Cyprus invested a lot, I will say that it seems to be excluded because shipping relies on tonnage tax and not corporate tax. So it seems that it will remain untouched and it will not be affected. So I will say that our attendees here, if they are looking for a career, maybe the shipping industry in Cyprus will continue to move on and thrive, such as investment funds as well. And of course, importantly, this is for legal entities or not individuals. So Cyprus needs to find a way to focus on individuals. And when I say individuals, I mean private clients, like high net worth individuals. And also there is a very good industry right now, the so-called digital nomads. These are the new startups, the new young generation that they are all IT oriented and very digital guys that they are moving and they are looking for a jurisdiction to do their business. They call them digital nomads. So this is an area, again, that we could focus because all this is not about individuals, but it's about corporations. Now, of course, in the Pillar 2, there are some carve-outs when it comes to Pillar 2. And these carve-outs, and here is that where Cyprus can focus on its tax incentives. The carve-out seems to be on payroll and tangible assets. So if you have expenditure focusing on important activities, on payroll and on tangible assets, such carve-outs are important because when doing our tax policy in Cyprus, we need to focus on such carve-outs because if not, then the Pillar 2 will whip out these tax incentives, because at the end of the day, Cyprus will be providing you a tax incentive and another country will take the tax benefit. So effectively, it's like giving money to another country with no benefit. So importantly, the tax incentives needs to be focused on such carve-outs that the OECD believes is important. Now, this is the same slide that I used before, but the reason that I'm doing this slide is to summarize what I've said. Is that my summary will be that if I do it on read mode, if we want to do a good reform, then maybe we need to focus on 2-3 pillars. I would say physical person is very important. Focus on private clients. From a legal perspective, I would say that this will be investment funds, shipping entities, and so on. That seems to be favorable from the OECD. From here, we don't have a lot to do on income, but we have to do a lot on expenses. And expenses are the tax incentives. And the tax incentives that we provide need to be in line with the carve-outs that I mentioned before. Of course, we have the discussion about the rate, but we have seen that the discussion about the rate is very sensitive. This is also obvious, and from the OECD, they don't want to touch the rate. Obvious from the EU, with the EU common consolidated tax base, they don't go to touch the rate. The rate is very sensitive. Of course, Pillar 2 discusses about the rate, but I will say the rate, I need a couple of days to discuss the issues on the rate and not just 10-15 minutes. So Eleni, I will be happy to speak on that on another webinar. The time today is not there to speak about the rate today, unfortunately. So I think I end up here. Yeah, correct. This is my last slide. And I hope you enjoyed my presentation.
Thank you a lot. If I allow myself, Christos, what would you propose as a tax policy for Cyprus to attract these digital business market actors? How do you see the reform, the tax reform to take place? My idea would be to go and be the first one to implement Pillar 1 on and create a mutual space where we discuss with the companies and we work together the circulars and we produce a standard model, business friendly, and within the framework of Pillar 1. What would your idea be, or your reaction to what I'm saying?
So I will say that doing a tax reform now, Eleni, BEPS 1, it consists of 15 steps. And each action point, each action step of the 15 is like 200 or 300 pages. So if you can make the maths, you will understand the huge development of international tax, and you know them because you are a tax advisor. If you add on that the pillar 1 and pillar 2, which is 200 or 300 pages each pillar, so you will understand how the international tax landscape change post-BEPS. That's why we split the international tax into era pre-BEPS and post-BEPS. So I will say that because they cover everything on the tax system in both domestic legislation and tax treaties and EU law, luckily we are still lucky or unlucky to be part of the EU. I will say that this needs a holistic approach. And my personal view is that we need to appoint an external advisor to work on this project. It will take them weeks, months to end up with a proposal because it's not just picking, cherry picking. I would say focus on this and focus on that, because all the steps, they can take aggressive measures from all around. The issue with BEPS is about substance, but they don't provide a definition on substance. So we have a different definition on substance when it comes to anti-avoidance provision. We have a different definition on substance when it comes to transfer pricing, when it comes to CFC, when it comes to other provisions. So it's not an easy exercise. This needs to an in-depth analysis of our system, which is 20 years old, is not brand new. And it needs to take into consideration all these measures, which you understand how depth analysis you need, and find the new way. But the new way will be focused on what I've shown you in the last slides, which is only a small part of all this, but it's not an easy answer, I would say. This needs to a huge tax policy initiative in order to end up with a good result, I would say.
Okay, so a new tax reform after 2003.
Yeah, our system is there. It worked for us for 20 years. It was good enough, but in the new era, I will say it's very difficult to be sustainable. We need to do something. I would say yes.
Okay, thank you, Christos.
My pleasure.
I did my master thesis on 2003 tax reform. It's been 20 years.
So it's a good opportunity for you, Elaine, to do another PhD.
No, that was my master thesis.
Ah, sorry.
I was young. It's time to do a new master.
Yeah.
With all these changes, yes, we all need a master or a qualification and revise everything on taxes.
Yeah.
Thanks a lot. Thank you all.
My pleasure.